Um, Domino's Pizza is getting completely crushed right now because, well, everyday families are just too squeezed to order a $15 delivery.
Right. They just can't justify the cost anymore.
Exactly. But meanwhile, Nvidia is quietly projecting to generate $400 billion in pure cash.
Which is just a wild number to even think about.
I mean, it's a number larger than the GDP of several countries combined.
Yeah, it really is.
So when you look at the sources you provided for today, it becomes immediately clear that we're no longer looking at, a single unified U.S. economy. We're looking at two entirely different dimensions operating on the exact same planet.
Yep, completely parallel realities.
One is completely frozen by inflation, and the other is like accelerating at light speed.
It really forces a complete reevaluation of how we measure economic health. I mean, the traditional metrics simply do not apply uniformly anymore.
Welcome to today's custom-tailored deep dive. We are taking your sources, specifically the daily market briefing for Monday, April 27th, 2026, and we're really pulling them apart to understand this completely fractured landscape.
It's a fascinating briefing today.
It really is. And our mission for you today is to figure out the actual mechanics behind this split. Like, how do we reconcile an environment where traditional consumer sectors are just suffocating under geopolitical conflicts while the tech sector is seemingly immune to economic gravity?
Well, to understand that split, we really have to look past the surface level index numbers.
Right.
Because the major indices, they mask the structural shifts happening underneath. We are witnessing a fundamental bifurcation in how value is actually created.
Meaning what, exactly?
Meaning physical constraints are harshly punishing old business models, while digital acceleration is rewarding new ones at, like, an unprecedented scale.
Okay, let's unpack this. We should start with the physical constraints, right? The macro pressure cooker.
Absolutely, you have to start there.
Because unless a company is operating entirely in a server farm, macroeconomic gravity still dictates the cost of doing business. And the most massive source of that gravity right now is geopolitics.
Yeah, specifically the ongoing war in Iran.
Right, which has driven oil prices above $100 a barrel.
And that $100 threshold is a massive psychological and economic tripwire. I mean, oil isn't just about the cost of filling up your gas tank.
No, it's in everything.
Exactly. It's the invisible tax on the entire physical economy. It dictates the cost of the plastic packaging on a retail shelf, the diesel for the logistics network, the electricity running the manufacturing plants.
Everything gets more expensive.
Right. And that direct energy shock is the primary driver behind the March Consumer Price Index, the CPI, increasing by 3.3%.
But wait, if the CPI is up 3.3% because of an oil shock, we need to look at the other side of the equation, right?
But a producer side, yeah.
Yeah, the Producer Price Index, the PPI, that only rose 0.5% in March.
Which was lower than expected.
Right. And the PPI measures what wholesalers and factories are paying before the goods hit the shelves. So if producer prices are dropping to a 0.5% crawl, I mean, the inflation pipeline is already freezing over.
It's definitely cooling down at the source.
So why is the Federal Reserve letting a temporary spike in oil from a geopolitical conflict dictate long-term interest rates? I mean, the Fed's key gauge for core inflation in February was 3%.
Well, it's because the Federal Reserve is looking at a highly complex global timeline, not just domestic wholesale costs.
Okay.
The PPI is a leading indicator, right? So if it costs a factory less to make a good, it should eventually cost the consumer less to buy it.
Right. Makes sense.
But the Fed cannot ignore the immediate reality of a 3.3% CPI because inflation expectations can become self-fulfilling.
Oh, like a wage spiral.
Exactly. If consumers believe prices will stay high because oil is high, they demand higher wages, which creates sticky inflation. Plus, the Fed doesn't operate in a vacuum.
Right. They have to look globally.
Yeah, they are closely watching the UK economy, for example, which just unexpectedly grew 0.5% in February.
Oh, wow. Really?
Yeah, and strong global growth means demand for raw materials remains high, which keeps pressure on the supply chain regardless of what domestic producers are paying today.
So the Fed is essentially trying to drive a car down a very, very icy road.
That's a good way to put it.
They're trying to carefully tap the brakes with interest rates to slow down inflation without spinning out into a recession.
Yeah.
But meanwhile, there's a passenger in the seat, geopolitics, who just keeps violently yanking the steering wheel by jacking up global energy prices.
And to make matters worse, the driver of that car might be changing soon, which adds a layer of immense volatility.
Oh, right. Chair Powell.
Yeah, Powell's potential exit is looming. And the internal politics at the Fed are fracturing. You have Fed Governor Waller publicly stating that the labor market and the Iran war are complicating the rate approach, signaling a highly reactive stance.
Okay, so he's watching the day-to-day.
Right. But then you have Cleveland Fed President Hammack advocating for strict patience. She's arguing to keep rates on hold and just weather the storm.
And the market is reacting to every single headline out of the Middle East like a seismograph. I mean, we get a whisper of a potential Iran ceasefire, and suddenly the market odds of a Fed rate cut this year violently shoot up to 43%.
Because the market is a discounting mechanism. A ceasefire means the geopolitical risk premium on oil evaporates.
Right.
If oil drops, CPI drops, and the Fed finally gets the runway to cut interest rates without risking a secondary inflation spike.
But those are just probabilities.
Exactly, just probabilities. Until a ceasefire is signed and rates actually drop, that high interest gravity is relentlessly crushing everyday spending habits.
Okay, so let's follow that gravity right down to the street level, to the consumer discretionary sector. We have a $100 barrel of oil and sticky inflation. But the way consumers are reacting is deeply paradoxical.
It really is confusing if you just look at the surface.
Right, because Domino's is getting hammered. Their stock dropped to 9.22% after they slashed their guidance.
A huge hit.
But on the exact same day, in the exact same squeezed economy, Bed Bath & Beyond, BBBY, emerged as the market's top gainer with a massive 25.47% surge.
Defying all the odds.
Yeah. They beat Q1 earnings with nearly $248 million in sales. So how does a consumer who can't afford a $10 pizza suddenly afford to drop $100 on high-end home goods?
Well, it comes down to the psychology of perceived value under pressure. Economists refer to variations of this as the lipstick effect.
Right, I've heard of that.
Yeah, when household budgets are squeezed by unavoidable costs like, groceries and gas, consumers relentlessly cut recurring habitual expenses.
Like ordering pizza.
Exactly. A Friday night pizza delivery is an invisible, fleeting expense. It is incredibly easy to quietly cut that from the budget and eat leftovers instead.
That makes total sense.
And Domino's relies entirely on that high-volume habitual frequency, so they feel the pinch immediately.
But a luxury duvet, or like a new coffee maker from Bed Bath & Beyond, is a visible, durable good. It gives the consumer a tangible sense of comfort and control during a stressful economic period.
The psychology plays a role, definitely, but Bed Bath & Beyond's 25% surge is really driven by cold, hard operational mechanics.
Okay, what do you mean?
They aren't relying on squeezed consumers buying a larger volume of items. They proved to the market that they completely overhauled their supply chain.
Oh, so it's about efficiency.
Exactly. They focused on leaner inventory, negotiated better shipping rates, and prioritized high-margin items.
Right.
When a company proves it can drastically lower the cost to sell a single item, it extracts more profit per transaction. Even in a terrible macro environment, the market will violently reward a company that fixes its fundamental operating efficiency.
So the old economy survival strategy is basically a brutal knife fight over supply chains and profit margins.
That's exactly what it is.
But here's where it gets really interesting. If we pivot from the pizza and home goods aisle over to the tech sector, we are entering that second dimension we talked about.
The parallel universe.
Yeah, an entirely parallel universe that seems completely untethered from the consumer price index or, what the Federal Reserve is doing. It's driven purely by the multi-billion-dollar AI hardware wars.
And the architecture of the tech industry is experiencing a seismic realignment right now. I mean, the briefing note's a massive shift. Microsoft has just lost its exclusive license with OpenAI.
Which is like a Game of Thrones betrayal. And while Microsoft loses that total monopoly, Qualcomm's stock surges 12 to 13% on the announcement of a massive hardware partnership with OpenAI.
Yeah, they are teaming up to build AI directly into smartphone processors.
So to understand why that matters, we have to look at how AI actually functions, right?
Right. For the last few years, the AI narrative was totally dominated by the cloud. When you asked a chatbot a question, your phone sent that data to a massive, centralized server farm owned by a company like Microsoft.
Right, miles away.
The server processed the data and sent the answer back. Microsoft held the keys because they owned the servers.
But this Qualcomm partnership signals a huge shift to edge computing.
Yes, the edge being the local device itself. Qualcomm is designing chips powerful enough to run complex OpenAI models directly on the silicon inside your phone.
So no pinging a server in another state.
No latency. Total privacy. It completely bypasses the cloud monopolies.
It bypasses the cloud, but it also bypasses the App Store. Which brings us to the casualty of this new partnership, Apple.
Right. They took a hit.
Their stock dipped 1.5% on this news. Apple's entire trillion-dollar moat is built on being the toll booth. They charge a 30% premium on developers because they control the iOS ecosystem.
Which is massively profitable for them.
Exactly. But if Qualcomm and OpenAI build an operating system layer that acts as like an omnipresent AI assistant running on the processor itself, doesn't that render Apple's ecosystem totally irrelevant? I mean, if the intelligence of the phone shifts entirely to a third-party chip, does the iPhone just become a beautifully designed but fundamentally hollow glass shell?
That is the exact existential threat pricing itself into Apple's stock right now. Apple's pricing power comes from seamless integration.
Right.
But if the core value proposition of a smartphone in 2026 is no longer the camera resolution or the screen, but the AI agent living inside it.
And Apple doesn't own that agent.
Exactly. If they don't own the best AI agent or the silicon running it, they're reduced to a hardware manufacturer, and hardware manufacturers operate on very thin margins.
Wow. And speaking of borders and barriers, this reshuffle isn't just about corporate warfare, it is colliding with actual physical borders. Meta was forced to unwind its AI acquisition by China, leaving its stock essentially flat today. We're seeing physical geopolitics throttle digital ambitions.
Because the concept of tech sovereignty is becoming heavily enforced, governments are realizing that the foundational models of AI and the neural network weights that power them are critical national security assets.
It's basically the new arms race.
It really is. Regulatory bodies like the Committee on Foreign Investment in the United States, or their international equivalents, they're stepping in to block the transfer of that underlying architecture across borders.
But amidst all this corporate maneuvering and geopolitical blocking, Micron quietly rode the tech wave to a 6% increase today.
A clue right under the radar.
Yeah. Because whether it's Qualcomm processing AI on a phone or Microsoft running it in the cloud, running these massive models requires staggering amounts of memory. Micron doesn't care who wins the war. They're just supplying the ammunition.
It is the ultimate infrastructural play. The companies providing the foundational hardware layers are the ones seeing the most immediate financial benefit from this reshuffle.
Which connects directly to our final focus today, the cash flow titans. It is one thing to see your stock surge on an OpenAI partnership announcement. It is another entirely to actually monetize this revolution.
Right, the actual money printing.
Exactly. Let's zoom in on the most active stocks today: Tesla, Nvidia, Apple, just to see who is actually generating cash.
And the market is currently rewarding underlying operational cash generation over pure revenue growth.
So what does this all mean? Take Tesla, for example. They actually missed their Q1 revenue expectations. They sold fewer cars.
Which usually means trouble.
Right. In the old economy, missing your top-line revenue targets usually triggers a massive sell-off. But the market is looking past the top-line revenue and reacting to their margin expansion and free cash flow growth.
Because margin expansion is the key mechanism here. Think about it. If Tesla sells fewer cars, but they have completely redesigned their manufacturing processes, say, utilizing massive underbody casting machines to eliminate hundreds of robots from the assembly line.
They drastically lower the cost to build each vehicle.
Exactly. They extract significantly more profit per car. Growing your free cash flow while missing revenue targets proves to the market that your underlying machine is highly optimized and resilient.
But if we're talking about optimized cash machines, we have to look at the numbers coming out of Nvidia.
The numbers are staggering.
The financial projection in today's briefing is almost difficult to comprehend. Nvidia is expected to generate $400 billion in free cash flow across 2026 and 2027.
It's hard to even picture that amount of money.
Just to ground that number for a second for everyone listening, Nvidia alone will generate more cash than Apple and Microsoft combined.
Because free cash flow is the lifeblood of corporate supremacy. It is the pure capital a company has left over after paying for every single operating expense, every employee, and every new factory. When a company has $400 billion in unencumbered cash, they can buy back their own stock to drive the price higher, they can acquire any emerging competitor, or they can fund research at a scale that makes it impossible for rivals to ever catch up. It quite literally gives a single corporation the financial leverage of a sovereign nation.
I have to play devil's advocate here, though. I want to challenge the logic of this projection.
Go for it.
Extrapolating a $400 billion cash flow assumes that the gold rush never ever ends. Right now, every major tech company is currently buying Nvidia chips to build their massive data centers.
Right, the build-out phase.
But eventually, those data centers will be built. The structural foundations will be laid. Isn't the market pricing in absolute perfection? I mean, they are completely ignoring the realities of the capital expenditure cycle. When the massive build-out phase peaks and corporate AI spending eventually cools down, that cash flow projection could evaporate overnight.
You're absolutely right, and that is the defining risk of the current market. When a company becomes the undisputed backbone of a new technological paradigm, financial models tend to just extrapolate the current explosive growth rates infinitely into the future.
Which never happens.
Right, capital expenditure cycles always peak. Building out the infrastructure for AI is highly capital intensive. Assuming Nvidia will seamlessly maintain these margins requires believing that the transition to AI is not a one-time build-out, but an accelerating, continuous upgrade cycle that defies the historical laws of hardware saturation.
It assumes the digital dimension will never face the constraints of the physical one. And that really brings us back to the core tension we've been tracking today. We are navigating a profoundly bifurcated economy.
If we connect this to the bigger picture, it's undeniable. On one side of the ledger, you have the messy reality of physical constraints. You have the Middle East conflict jerking the steering wheel on global oil markets. You have the Federal Reserve trapped between freezing wholesale costs and sticky consumer prices. You have families cutting their Friday night pizza budget, forcing legacy companies into a brutal knife fight for operational efficiency just to survive.
And on the exact same day, in the exact same market, you have the digital dimension. Qualcomm fundamentally restructuring the architecture of the smartphone, Apple fighting an existential threat to its App Store moat, and Nvidia projecting a cash flow that rivals the GDP of entire countries.
It's completely disconnected.
The tech sector seems entirely divorced from the reality of a $100 barrel of oil.
And understanding the structural divide is critical, because if you only look at a broad index fund, the blended average makes it look like the market is functioning normally.
Right, it smooths everything out.
Exactly. But those passive funds are masking a violent tug-of-war beneath the surface. The crushing gravity of the physical economy is pulling downward, while the rocket ship of the digital economy is tearing upward.
It really makes you wonder how long the connective tissue between these two economies can actually hold. And I want to leave you with a final thought to mull over as you digest these sources. We have a single tech company, Nvidia, on track to generate more unencumbered cash than several small countries combined. Meanwhile, everyday consumers in the physical economy are balking at the price of a Domino's pizza.
It's a stark contrast.
If the wealth generation of the tech sector continues to detach this violently from the physical economy, are we reaching a point where the tech giants become too large for our current economic structures? Will they eventually have to build their own parallel financial systems, like their own lending networks, their own currencies, simply because the legacy banking system can't efficiently deploy that much concentrated capital?
It is a scenario that moves from science fiction to financial reality a little more every single day.
It's like looking at those two disconnected thermometers on the back porch. One is freezing over with inflation, and the other is melting from the heat of AI growth. Eventually, the pressure is going to shatter the glass on one of them. Thank you so much for joining us on this custom deep dive today. Keep questioning the mechanics behind the data, keep looking beneath the surface, and stay curious.